Welcome to Inside the Road, the podcast where we speak to the leading minds in wealth management. I'm your host, David Clark, and I'm happy to bring you another episode of our podcast. I'm joined by Tom Oriel, as usual. Please, as a note, just to remember to listen to the disclaimer at the end of the podcast, and the podcast is recorded for information and entertainment purposes. G'day, Tom. How are you going?
Good, David. How are you?
Yeah, really well, thanks, mate.
So we've got Jeremy Samuel, Managing Director and Founder of Anacacia Capital on the podcast today. I didn't know at the time, but it sounds like you met Jeremy back in 1999 when he was a young analyst, and now Founder and Managing Director of Anacacia Capital. What are the key things you want to get out of the episode with him?
Yeah, look, I've known Jeremy for a long time, and I've sort of kept close to that story and checked in a little bit along the way, and I've just found him to be someone that's really smart and thoughtful, and he's got a track record that reflects some really strong capability. I'm really interested to hear his story and journey, and I also know that the study he's done at Yale and how he's been mentored by David Swensen, who's regarded as really the grandfather of this endowment style investing, which lots of large institutional, almost probably the best category of investors in the world has really adopted. So I'm really interested to sort of break that down with Jeremy.
Yeah, absolutely. And I think, that whole piece about the endowment style approach, which we've talked about, and you've had a lot of people on the podcast in the past, and we've had uncorrelated strategies and things like that will be really fascinating to learn about. I think the other point going into it for all the keen golfers that listen to the podcast is Anacacia's investment in MGI, which are the robot buggies everyone sees floating around golf courses at the moment that you own, that I own, that a lot of people have have purchased over the last few years. I'm keen to hear about that story. It's sort of a 30-year family-run business that Anacacia participated in ownership of. So
yeah, well, I want to say that their performance of their PE funds has been really good. Depending on which vintage, sort of between 15 and 25% IRRs. So right in terms of what you'd expect in PE, and my other question is they're a real traditional PE house, as you know. So understanding how that works together, the Wattle Fund in the small cap space, I think it's been about 13.2% per annum compound annual growth rate against a benchmark of somewhere around the 8% mark. So it looks like they've got the runs on the board, really small sort of boutique house in terms of those conversations we generally have. So
yeah,
keen to get into it.
Chasing value and not scale. Should be good.
Yeah, let's get into it. Jeremy Samuel, welcome to Inside the Road.
Thanks very much, David. It's great to be here.
Well, it's been a long time coming. I reckon my guess is that I first met you in about 99 as a young associate investment analyst at Newport Capital. And I think that might have been sort of 99, 2000, just before the sort of tech wreck or just after it. Great to have you on the show. For the listeners, give a bit of a background as to who Jeremy Samuel is.
Yeah, no problem. Look, you can probably tell by the accent, born and bred in Australia from a great loving family, married with 3 kids. I've got a wife who's an artist, so brings very complementary skills to the household, and 3 lovely kids most of the time who keep me very grounded. But in terms of sort of since those days since we met, and at that stage I was working for ANZ on their on-balance sheet private equity business. And if you kind of roll the clock forward to today, we'll talk in a bit more about Anacacia that we founded in 2007. But one of the, strong or influential parts of their background was going over to the US and doing an MBA in the late 90s and being very fortunate to be sponsored to go to Yale, studying an MBA at the School of Management, received a fellowship from the Yale Investments Office, which has great pedigree in terms of investing, particularly in alternative assets and the smaller end of the markets, and really learning a lot from that time. So, for example, and maybe we'll pick up on this later in the conversation, but the importance of inefficiency in markets and how not necessarily following everybody else is necessarily the way to go. So, roll the clock forward to today. We've got I run the Anacacia Capital team. We've got 16 professionals. The 6 of most senior people we've worked together now for more than a decade. So I've got lucky to have the most fantastic colleagues, very passionate about investing in leading small, medium-sized, profitable, dividend-paying, well-managed companies.
want to really get into Anacacia and sort of small caps and PE, but I just can't step past. I think it's David Swensen,
That's right,
who you've been mentored by, and for listeners to the podcast who aren't familiar with Yale and the Yale Endowment and Swensen, he was this. You know it much better than I do, but my cut on that is that he was the CIO of the Yale Endowment. The Yale Endowment has become the model for which around the world most sovereign wealth funds, think of the Future Fund, think of the large GIC,
Yes.
all of these Temasek, all of these sort of firms in this endowment style of investing, this, that there's profit to be made out of the inefficiencies in public markets and the information flow and the illiquidity premium and investing in alternate assets to smooth returns. He's really one of the prime influences in that whole movement over the last 50, 60, 70 years. So I can't walk past the fact that you were mentored by him in that. Tell us a little bit about him and what you learnt in that process.
Yeah, no, look, absolutely, David. And look, he was a remarkable man. Unfortunately, died a couple of years ago. But as you said, he ran the Yale Endowment for about 30 years. By most US investors would say he was one of the greatest investors. He's not well known by retail investors, but really focused on trying to build an endowment for generations to come, and thought about, rather than just focusing on a mixture of fixed income and boring US sort of stocks, trying to pick good quality managers across diverse asset classes and with a strong alignment of interests. And learned a lot, I guess, from him and from his team, really about what is it that makes a manager successful. And one of the things that, in that sort of late 90s sort of period in the US, there are a lot of private equity firms. There are a lot of public equity managers in the US. So then coming back to Australia in 2000 and really thinking about, in a small market like Australia, how can you do things a bit differently? Like, there are many fund managers in Australia that do very well relying on broker research in the public markets or on the private markets, relying on deals that come through investment banks and advisors. But one of the things I learned in the US, in these super competitive markets, the very best firms do their own research. They reach out directly to companies. They look for inefficiency in the market. Just because everybody else is getting bigger, they don't necessarily get bigger. So that informed a lot of when we started Anacacia now 19 years ago, and still what we do today. We put a lot of our own personal capital, into the funds that we invest in, and we're looking for, well-managed, well-structured businesses with a good competitive advantage, and not necessarily wanting to do what everybody else is necessarily doing. There's strong incentives in the funds management industry, and David wrote about this and spoke about it a lot, about just getting bigger and just going for scale and for the sake of scale.
Be a great marketer, hug the index.
Yes.
Concentrate on marketing, distribution, getting your brand name out there, getting lots of funds under management, and not necessarily adding value or performance.
That's right. So they spoke a lot about, it's easier sometimes to fail conventionally rather than succeed unconventionally. And I guess at Anacacia, we've always tried to balance preserving capital with just eking out double-digit returns, but by going and swimming in places where maybe others aren't. And that's not, if you kind of think about the funds management industry, and you're an expert in this, David, so I'm telling you stuff you already know, but there's some very successful fund managers that have got very, very large, and there's good incentives to do that. And there are also some very successful fund managers that invest in very early stage, sexy companies that are doing, high growth, not profitable, but hopefully one day will be. And there've obviously been some very prominent examples of that recently. Not many people are interested in investing in, established, profitable, here today, here tomorrow sort of businesses. But that's what we're really passionate about. We think that's a good way to manage risk. And we think there are enough problems with, really good businesses, let alone, bad businesses or businesses that are very small or very complex. And that's not to say that, companies like, ANZ and Westpac and NAB and CBA, they're terrific companies. But, we don't think we have a competitive advantage working out why one's better priced than another. At the same time, the very smallest companies, say in an ASX context, the smallest 1,000 companies, there are a lot of very interesting businesses there. Some of them are doing mining exploration or property, or they're technology early stage companies that maybe we saw through our private equity funds and they were able to sort of get away and sort of list. But the focus for Anacacia is in that mid-market established businesses with a really good sort of track record. And that's one of the lessons I learned from that US sort of experience. And we sort of take to what we do today in Anacacia. We've been fortunate. We've raised, over $1 billion over the last 20 years. So it's not an insignificant sum. But compared to where most fund managers are, we're happy to keep our fund sizes, limited and focus on that.
Magellan of the world that grew to $140 billion.
Yeah, exactly. I mean, you think about I think the top 5 super funds in Australia now each control well over $100 billion. And if you think about if they're wanting to make deployments into fund managers and if they want to have less than 100 relationships, it means they're writing checks of, well north of $1 billion. And the average fund manager doesn't want one super fund to be 100% of their fund. So you can you sort of do the maths on that and you can see that there's sort of huge economic sort of pressure, and part of it's government policy and part of it's the way the markets have sort of operated. And there's nothing wrong with deciding to go down that path. And there are some great businesses that have decided to become, very large. And, many of them now look like banks in their own rights, on a global sort of scale. But our decision as Anacacia is to stay privately owned. We look like many of the investors that invest with us in that we're a private Aussie business where we put a lot of our own capital into the companies we invest in. And we love backing these entrepreneurs and founders who have done a really successful job building their business to a certain stage. And we have today both funds investing in private companies and we also have funds investing in the listed market.
Tell me a little bit about the journey. Was the private equity first or the public markets first? How's the journey progressed?
Yes. So we started on the private equity side, and since then we've raised 5 series of private equity sort of funds. And we've been fortunate.
Sort of small to mid growth, what the market would call that sort of growth, small.
Exactly.
Market,
leading.
Not venture capital.
Correct. So leading small, medium-sized businesses. So consumer, industrial, service type businesses. So for example, we invested in companies like Rafferty's Garden. So for some of your listeners or watchers today who've had kids in the last 10, 15 years, they've probably fed their kids with Rafferty's Garden baby food. So, we're the majority investor in that business. Or I know you're a golf fan, things like MGI, the electric golf buggy business.
You have to excuse me, and listeners, you've got to excuse me here, but I've been back on a golfing bent now for 2 years and right into it, and I bought my wife Nicole for Christmas an MGI buggy.
Fantastic, excellent. Yes,
to go along. So when I learned that you're an investor in it, I was just very excited for my own sort of, how it's a product I love.
Yes,
and it's good. But I'm interested. That's a good way to draw it out, maybe.
Yes,
I want to do it.
Yes.
What? Give us an idea there of, size of the company, what looks and feels like, what attracted you to invest in it, and what attracts you in the future.
Yes. So MGI has been owned by the same Australian family for 30 years. The patriarch of the family that was kind of running the business was getting towards 70 and a bit over 70 and was thinking about succession planning.
So backing up for people, this is an electric golf buggy. So, if you play a Pennant Hills golf course like I do, and it's very, very hilly, it's very handy to have one of these things that, battery operated, takes it up and down the hills for you. Now they're getting fancier where you can use a remote control. Sorry, go on.
No, that's 100% right. So you walk the course, but you put your golf clubs in a buggy, and the top of the line model's got a remote control and it's GPS. It tells you how far you are from the pin, and there's a whole range of sort of products. And it's a great Aussie innovative company. It won't help you hit the ball, but it will help you to focus on hitting the ball, so you don't have to worry about getting a sore back. But you also get the exercise of walking. And so this business has sort of grown up, and it's now, it's the market leader in electric buggies in Australia. We actually sell more product now in the US and Canada than we do in Australia. Ian's got 2 super smart daughters. So in this case, the daughters work in the business. One runs the operations out of Australia and one runs the operations out of the US. But for him, he was getting to an age and stage where he was wanting to diversify his wealth. So we got to know him several years ago. We stayed closely in touch. And then when the time was right, we then spent several months doing detailed due diligence on the business, making sure it wasn't a fad. It wasn't just David and his wife weren't just going to play golf for a week or two, but this is actually a structural trend towards more people playing golf, more people wanting to spend money on technology, more people within that looking at the MGI product and seeing that it's got a really differentiated sort of offering. So we bought a majority stake in the business. The family members that were active in the business became direct equity holders, as did some of the other senior managers. And it's a terrific business, very profitable, very innovative. And it's the sort of company we love sort of backing. And, so we have consumer companies like that, or like Rafferty's Garden. We have industrial businesses. So last year we sold one of our companies, Force Fire, that we've been invested for a while, that does fire safety, to a listed Australian company. And we also do service type businesses. So for example, we're invested in a company called RP Infrastructure. It's got 400 or 500 people around Australia that advise mainly government on infrastructure developments, things like Melbourne University or Melbourne Airport, or building schools, building hospitals, building infrastructure around the place.
And when you come in, are most of those transactions competitive, i.e., a great saying I heard the other day, the difference between public markets investments, where I think your mentor, David Swensen, might talk about these type of things. That you just said, a CBA stock, you don't have competitive advantage over the research. But also there's lots and lots of people and lots of money that can just buy that stock.
Yes.
In the private markets, not only does the investor have to pick the investment, the investment has to pick them.
100%. So it's
my big question is that a competitive process where you're playing? I'd imagine there's a founder. I'm staying with it just because I love it.
Yes.
And that, you've got someone who says, well, I've worked hard for 30 years. I've got all this equity in this unlisted company and capital. Probably, on paper, I'm worth a lot of money and my cash flow is probably, it'd be nice to sell some of that stock. But, my daughters are in the business and I might want to keep them in. Is that a competitive process?
Yeah, it's a good question, David. So when an owner is looking at selling a private company, and many of the audience today would know this because they probably created a lot of their own wealth through their own sort of businesses. When it comes to sort of selling or looking at the liquidity event, it's a massive part of your life. Normally the business is like another child, and it's something you've got a great passion for. And the criteria that you're looking for often is to get a fair price, but a price is not the only factor. You're looking at other things. You may want the kids in the business. You may not want the kids in the business. You might want to look after the staff that are there. You might have a particular affinity towards some of the customer segment. And most importantly, what we find, most owners, they want to make sure that someone like Anacacia is going to be a good custodian for that business. And they realize we won't be there forever, because ultimately we're trying to make a return for our investors. So we'll get dividends along the way and ultimately have... Exactly. We'll ultimately have some kind of exit. So Anacacia is a bit unusual in that most private equity firms in Australia buy businesses through investment banks and through relatively competitive processes. Anacacia, while we always like people to be well advised, we've never bought a business without having exclusivity. So what that means is we'll get to know the businesses quite well. We'll agree in principle kind of what a deal structure might look like. And then the business owner and us will agree to spend several months working exclusively on the due diligence just to make sure they're comfortable and that we're comfortable. And that's quite unusual in the Australian market. And it was one of the lessons I learned from within the US, that while it's tempting sometimes for people to sort of sell businesses through a competitive process. It's a bit like a property auction. And sometimes people buy businesses like that. For us, we find that's very risky. Like, we want to get to know the people well. We're not interested in a chaperone process where we're just looking at a piece of paper. We've got to really get to know them. And ultimately for us, the criteria for any good investment, and it's the same in the private equity part of the business as in our listed equity part of the business, really only three things we're looking for. A really great quality management team with an aligned interest. So MGI's got that. They've got like a super management sort of team. Business like Rafferty's Garden had a fantastic management team. One of the things they were looking for us was to help complement that, because the founder was looking at retiring. So he wanted us to help him hire a new CEO so he could focus on mixing the fruit and vegetables and the baby food, and he could have somebody else who could focus on the relationships with the big retailers like Coles and Woolies, etc. So management, that's the first thing. The second thing is the quality of the business. What's its competitive advantage? Somebody like MGI, how's it able to get such strong margins? Why is it that David says, hey, I'm going to buy my wife an MGI rather than buying some no-name brand out there? So really understanding what's happening in that market, and has it got a competitive sort of edge? And then thirdly, is there a price and a structure which is fair and reasonable? So in that case, the family had a good sense as to what they thought was fair. We had a good sense what we thought was fair, and that aligned. And having those three things is really important. And even in the listed equity market, like, we don't invest in that large end of town because it is quite efficient in terms of sort of the pricing. We don't invest in the very smallest listed companies because it's very illiquid, and if you make a mistake, you can get stuck. But in that mid-market, we can find businesses where we look like there's very strong management, where they're well aligned, they're incentivized in the right sort of way that aligns with shareholders. We get to understand that business. Has it got a good competitive advantage? And then can we enter it at a fair sort of price? So, for example, we're invested in a company like Cogstate, Australian business. We'd never invest in something that does drug discovery. That's too risky for us. Very good for society, but not really, our risk appetite. But what Cogstate does is it is a supplier to the major drug companies like Eli Lilly and Pfizer, particularly around drugs that involve cognition and Alzheimer's. So they've got automated way of sort of testing and helping with trials for sort of drugs. Great Aussie business, exporting to the US and sort of globally. Not well known, it's a few $100 million market cap. Those large sort of super funds that are backing those very large fund managers we spoke about before, or the index funds, they're not focused on companies like that. And similarly on the private equity space, the big global firms can't invest in companies like the sort of businesses that we're investing in that might be making $10, $15 million of earnings a year on $50, $100 million turnover. Because if they did that, they'd have a portfolio of 10,000 companies or something, and it means they just can't focus on it.
It does very, very well. It makes no difference. If it does very, very poorly, it makes no difference.
Exactly.
The rating is so small. So when did you start the listed funds, and what listed funds do you have now?
Yeah, so we went into
investing in.
Yeah, so we started the first private equity fund was 19 years ago. And then about 11 years ago, we launched into Australian equities. And, with hindsight, I think maybe I was a bit silly because we had, for a few years in the lead up to that, we had a number of our family office and institutional investors and high net worth individuals saying, look, why don't you invest in listed equities? Why, Jeremy? Anacacia's got this, one of the best track records globally of investing in private equity. How come you're not investing in the listed space? And I always was a bit dismissive and said, well, look, listed equities is, it's a different space. We're not brave enough to try to privatize a listed company. We don't think we should be paying a premium to where listed markets are. So we kind of leave the listed space by itself. And then we've had listed companies coming to us and saying, hey, we'd love you to join our register. Have you thought about doing that? And we'd say, well, what about all those fund managers out there? How come you're not talking to them? And they said, oh, look, we're too small to get their attention. They're really interested in the ASX 100, the very largest companies. We'd say, what about the stockbrokers? Well, people don't worry about research anymore. There's very little focus on that. And the research that is there is very focused on the large end of town where the investment banks can do capital raising. And so it's hard to get attention. So we thought, wow, that sounds like inefficiency. Like we love inefficient markets. So we did a lot more work around it. And then in 11 years ago, we hired a team, 2 guys who are still with us today, who had public equity experience and launched the Anacacia Wattle Fund. And really with an objective of saying, let's try it over the long term, medium term, balance capital preservation with achieving 10% plus returns over the long term by backing exactly the same sort of companies that we've done historically, but acknowledging that the main difference is how you get in and how you get out is very different. So in a private company, as you alluded to, David, it's illiquid. If you invest in that company and whether or not it's going well or going badly, you're stuck with it until you're ready to go through a sales process. And that sales process can take many months or years. A listed company, you can sell it tomorrow. So for us, we said, well, let's hire 2 great, some great minds that have got listed equity experience, but understand the Anacacia way of thinking about businesses, about their long-term intrinsic sort of value. So rolling the clock forward to today in 2026, we have 3 parts of the business. We have the private equity funds. We raised 2 funds last year, so there's nothing available right now for investors on that front because we're investing that capital. And on the listed equity side, we don't publicise a lot, but we have 2 funds that are open on a monthly basis for investors. The Anacacia Wattle Fund that invests in Australian small, medium-sized listed companies, typically dividend-paying, profitable, well-managed companies, so all that criteria we mentioned before. And then we also have a global equities fund that we started 5 years ago that does something very similar. But for many of our investors, were coming to us and saying, look, I've got a strong home country bias. I want to have some exposure to international equities, but I want to do it through an Australian manager that has a lens that I kind of understand and get. So one of the couple of guys we hired more than 10 years ago, he went off to the US, spent a couple of years working for a fund over there, and then rejoined us more than 3 years ago. And he now is out of New York, runs our global equities fund. And so private equity, listed Australian, small, medium-sized companies, listed global, small, medium-sized companies. They're the 3 different offerings that we have for investors.
fund sizes. So the PE, the last two
Yes.
funds that you did were about what size?
Yeah, so look, we like having funds that sort of are a couple $100 million or so. So last year we raised a new primary fund of a couple of $100 million, and we did what they call a continuation fund, where we took 3 of our assets, which were performing really well, had returned all of the capital already to investors, and we gave investors an option. You can either sell out now, or we had effectively some institutions that underwrote a capacity for them to either to sell out or to stay. So we've rolled forward with those companies. And then we have a similar amount, about $250 to $300 million in our listed equity funds, which is predominantly in the Australian fund. No, in aggregate, and that's predominantly in the Australian fund. Yeah.
Whenever I hear that,
yes.
Did you roll your interest forward or crystallise some of it?
If you mean my personal interest,
principals.
The principal interest. So we
one of the big things,
yes,
Swensen always talks about is the
alignment of interest. Yes,
and I know I've had Mike Lucan on the podcast, and he just said follow the money.
Yes. So we did reinvest our money into there personally, and I think we put a lot of our own personal money into all our funds, including that. And look, but having said that, we said to our investors, look, there's no judgment here. We've been in these businesses for 5 years plus. If you want to triple your money and take your money out now, you absolutely can. We personally are rolling our money into this new vehicle because we think we could hopefully double or triple our money again over the next 3 or 4 or 5 years. But we might be wrong. It's possible that the businesses may not do so well. So very much for all our businesses, I've just recently topped up my personal holding in our 2 listed equity funds. I might be wrong, but we just think that when we look bottom up at the companies that we're looking at, we're fortunate to work with some really great companies, and it's not easy. Like everybody, we make our mistakes along the way, and on any given week or month or day, you can feel sick in the stomach when things don't do quite so well. But over the longer term, we've been very fortunate to get some strong returns for our investors.
And how's strong returns for your investors? What have the performances been roughly, in the PE space, and then in the Australian small caps and the global small caps?
Yeah, look, the private equity in theory should get higher returns because you've got illiquidity, and that has been our experience. So, we've been fortunate that investors that would have been with us for 19 years and invest in every one of our funds, their returns would have been north of 25% per annum, net of all expenses. So it's a phenomenal return, and we spend a lot of time telling our investors, please don't assume that's necessarily going to be the case in the future, but the returns have been strong. I think it's 27% or something per annum. Now, within that, our worst performing fund's been 10% per annum, and our best performing fund's been 42% per annum. We've never lost 100% of our money on any individual deal. We will one day, but it hasn't yet happened. We have lost capital on some individual companies, but an investor gets exposure at a fund level. That's why one of the...
And the PE funds have about how many companies in them?
Typically 7, 8, 9, 10 companies or so in each fund, so fairly concentrated. And we watch them well, and we're actively involved in those companies. We typically have 2 or 3 of us on the boards. And then on the listed equity space, we're targeting 10% per annum over the long term. So our longest fund, which is the Anacacia Volatile Fund, has achieved about 13, bit over 13, maybe now 14% per annum net of all expenses over that time period. And our global fund, we started just before the COVID period, so we kind of went down like others sort of did. So it depends on the period you look at. So FY25, we made a 25% return, and the last 12 months have been, or 12 months have been much more challenging. We haven't met that 10% sort of hurdle. So it's...
I'd imagine you strike me as quite a fundamental investor in terms of your language around value and inherent cash flow going forward.
Yes.
And then you say, well, the last 12 months has been a little bit tough.
Yes.
It's interesting because I think there are a lot of investors in the market that are looking at, US, SpaceX, all these things going out, a heap of FOMO, 100 times revenue, scratching their heads. And then in the Australian market, you've had the banks that, I, for one, have probably been saying these don't look like great investments. In the last 5 years, a lot of the people I listen to and think are very, very smart are saying that, it's like 28 times earnings. Not very smart, but you've been proved to be wrong. The scoreboard is the ultimate goal over the last 5 years. I guess, how are you viewing that dynamic at the moment?
Yes.
Being, somewhat traditional value-based, where a lot of the market seems to be almost transitioning, or this fear of missing out.
It's a good question, David, and you need emotional stability to sort of think through that. And we're very, very lucky to have investors that, while in our our listed equity funds, people can pull money out, say, on a quarterly basis. Most investors think about it as a multi-year type investment. Our Wattle fund, it's achieved 13 or 14% per annum. The All Ordinaries over the same period of time has achieved, I think, 7 or 8%. So, we've achieved well above that. But there are some periods, like you say, where there's a strong focus in markets on businesses that are, loss-making but with huge growth potential, or, maybe they're steady, like banks that are on sort of, seemingly very high multiple. And the key for us is just not get distracted by that. If people want to get exposure to that, they absolutely can, but that's not what they come looking for Anacacia for. For Anacacia, they come to us to look for profitable, dividend-paying, well-managed companies where we're paying a disciplined price. And that means if we're not seeing that discipline, if we're not seeing good value, then we'll step away and we'll hold cash within our funds. And we're not afraid to do that. And our investors are incredibly supportive of that, and they've been rewarded for it. If you're kind of worried about, putting your money in one day and out the next day, then you can have sort of a different sort of view. But as you allude to, David, I guess our view is that there are some amazing large companies out there, but they are somewhat priced to perfection. So we're seeing more and more investors that are saying, oh, look, I still want some exposure to that larger end, but I want to get some exposure to that smaller end, because we know over the long term, those smaller companies, typically it reverts back, and the multiples sort of can somewhat sort of even out. And the view on, risk for us is often really about capital preservation. And if you're paying 100 times revenue for a business, gee, maybe you'll do well, but maybe you won't. Maybe you'll blow up a lot of capital. So I feel much more comfortable paying not 100 times revenue, not 100 times earnings, but 5 times earnings or 6 times earnings for a business that I think is well managed with an aligned management team. And the fact that a bunch of other large institutions are not interested in it and are not sitting on the register, I don't care. I'm interested in them being a profitable business that longer term will grow value for our investors and protect the capital that they've got. So it's not, again, judging people that may want to invest in those large companies or the sort of, sexy early stage sort of businesses. And some people, we'll never make 100 times our money in any one of our investments, but hopefully we'll rarely blow up the capital either.
Yeah, it strikes me. I was looking at some data recently that suggested all of the really, on a global basis, really successful companies from IPO that are all more than 100 times X from IPO price.
Yes.
They've all on average suffered declines of, on average, 65% in their share price, and taken 8 years on average to get back to the price before the fall. So they're wild rides.
Yes.
I think the concept that, you talk about Amazon and a lot of these big tech companies, getting comfortable with the price to get in. A lot of people can never get comfortable with that. And then B, being able to stay for the ride when it draws down more than 50% over a 10-year, 15, 20-year period.
Yes.
Most people don't have the stomach for it. The only ones I'd say who've got the stomach for it
yes.
are passive ETF investors and Berkshire Hathaway.
Yep.
Right?
Yes.
So,
and you can, as an investor, you might say, look, I'm going to have some exposure to that. I'm going to go to a smart guy like David who's going to say, look, here are the best people that can kind of give you some exposure to that. But you might also say, well, gee, I also want to get exposure to that kind of boring, inefficient end of the market, which kind of just ekes out sort of profitable returns and the valuations don't look demanding. Because a lot of those companies are, they look like they're priced to perfection. They just they make a few mistakes, then suddenly they can get really sort of punished. And that's not to say that, smaller companies can be impacted by that too. But we look really hard at trying to find those well-managed companies, fair prices. And if we make a mistake, we feel like we can get out. There's enough liquidity, we can do that. And on the private side, it's important for us to, again, well-managed, good quality businesses. And we have enough, we want the management team to control the business day to day, but we want to have control at a board level such that also we can influence things if changes are required.
So what are you excited about at the moment? What are some things that you're excited about?
Yes.
And, like a perfect day, if this presented in your inbox tomorrow morning, what would be ideal? And then on the other side, what are some of the things you're actively avoiding in the market at the moment?
Look, there are a few things. I think, this might sound a bit strange, but our investment team's always got a skip in their step when the markets are down, because they're saying, well, the business today that we're looking at investing in, it looks like exactly. It looked very similar yesterday to what it does today, and the markets are lower, and so you look at something like the March quarter this year, and the March quarter, many companies, their share prices were hit quite hard, and if you're a forced seller, really difficult. But if you're not a forced seller, was a great time to sort of buy it. So, many of us were sort of, investing, further at that sort of end of the market. So that's one thing we look at. But the thing that gets really excited is when we see a great business with a gun management team who are shooting the lights out. They've got a lot of their own money invested in the company alongside us. And, there's always challenges, but how they deal with those challenges can be really, really sort of positive. And you make some mistakes along the way. Like, I think about something like, Rafferty's Garden, the baby food business that I mentioned. You and I would have been fed as kids on Heinz, sludge in a jar. And my parents and my grandmothers who were born in Australia, they would have been fed on Heinz stuff. Heinz had 80% market share for generations. And this business came along, Rafferty's Garden, in a pouch type product where they had no additives. That was kind of its big sort of selling. And it was a different manufacturing process. And we invested in that business and we helped them to expand to be national across Coles and Woolies and exporting off overseas. And, I remember one day Audi launched a copycat product. They went to one of our suppliers and it was devastating for the management team. And they came to the board. I was one of the directors on the board and said, look, this is, we've got this great successful baby food business, but, Audi have just gone and they've launched a copycat product. They've gone to one of our suppliers. And at that moment in time, the value, that's an example of a private company, but the value of that business, very profitable, suddenly felt worth a lot less, right? Now, as a private company, we can't sell it. So we've got to then think, well, how do we respond to that? So the management team said, look, one option is we could sue Audi. We think that they've breached our intellectual property. They're using our special, way of doing things. But we took a different view. We said, look, we're not litigious. What we're going to do instead is we're just going to innovate even better. So Audi, good luck. And we're going to make sure that we have a more diversified supply chain. We're going to make sure that the suppliers we've got, we thought before that they were exclusive to us, but now we kind of realize, well, one of them, it wasn't quite as watertight as we realized. And with hindsight, we made that was a mistake that we kind of learned from. So firstly, you think about how are you going to respond to that in the moment? So we thought, well, what we're going to do is we're just going to innovate and grow. And that business ended up having 40% share of baby food in Australia. We overtook Heinz as the market leader. We sold it to a British listed company. Our investors made, more than 10 times their money. It was an awesome investment, but it had some moments like that were really troublesome. But then going forward, how do we take that, institutionalize it within Anacacia so it makes us better investors in private and listed companies? So now we're like very, very particular about understanding the supply chain for the businesses we're investing in. If somebody just says it's exclusive and we see a bit of paper that says it's exclusive, that's not really good enough. So we've got to make sure that, we want to speak to the suppliers. We want to understand what's going on. And then even then, if they breach it, we want to make sure, have we got alternatives? Where else can we kind of get those sort of products? So we're constantly trying to learn. And that's one of the exciting things about investing as well. Yes, you get some successes, which is great. And it's fabulous to make a difference to our investors' lives and be able to sort of create some real wealth for them along the way. And it's terrific to work with sort of management teams. But I'm also lucky to have a super smart management team around me. The 6 most senior people at Anacacia have worked together now for more than a decade. We've got some great emerging sort of talent in the business as well. And that's a great joy in business, to work with smart people with an aligned interest, have great advisors like yourself and others that are out there kind of giving sort of input also, and backing really good quality management teams. It's a very, very fortunate position to be in.
On the flip side, Jeremy, what are you actively trying to avoid, or are you worried about today that you're seeing getting around the market?
Look, we look very much bottom up at each underlying business, but of course we worry about macro factors. So, there's definitely inflation in the system. There's things like AI is super exciting, but there's also, it's somewhat sort of concerning, and some of the things that may come from that. And wherever there's kind of, people are worried, we obviously worry because we're human like everybody else, but it also creates great opportunity because you see people overreacting. Some software companies we think maybe get oversold. Some should have been oversold. And, fortunately we're not, if they weren't profitable, we probably weren't there to sort of start with. So you sort of see those sort of opportunities, but we're particularly focused at the moment on inflation in the system and businesses that have the capacity to pass on price increases. Have they got pricing power in that market? And thinking about, businesses that can't do that, we're kind of, somewhat concerned about. Startups, we've never been involved in that sector. It's super exciting. It's interesting. I admire people that feel like they can, pick good quality managers in that area, and it's good for society that there's capital in that space, but that's not the Anacacia risk profile. Mm-hmm. And then at the large end of town, similarly, there's many ways to get exposure to that end of the market, but pricing, as you alluded to, David, seems very high. And so, that kind of worries us. But, what's interesting is the performance, for example, of the Anacacia Wattle Farm. And you alluded to this before. Over the long term, we've performed way better than the market. But if you break it down by month, the months where we perform best are actually in the poor performing months for the index. So when the market generally does poorly, Anacacia does well in a relative sense. Now, we're not, as you alluded to before, we don't kind of judge ourselves by, where the index is. We're not paid based on that factor, but we realize it's the reality of the market you're in, so we inform investors of that. But it is kind of interesting that the data supports what we tried to do when we set up Anacacia really 19 years ago, which is trying to protect capital, eke out double-digit returns for our investors, perform through different sort of cycles. Businesses like Rafferty's, which is one of our most successful investments, or Appen or Lom Scientific, and a lot of those businesses we invested in during the GFC. During that COVID period, some of our best investments were made during that COVID period, that first couple of weeks when it seemed like almost everybody was selling. We had brokers kind of calling us to say, what are you doing? How come your team's buying shares at the moment? Everyone else is sort of selling. And being able to have investors that could kind of look through and kind of think through, look, I'm looking at holding onto this investment for several years and having the capacity, given many had sort of backed our private equity funds then in the listed equity space, gives us the confidence as an investment team to say, hey, let's make sure we're investing in well-managed businesses. And when the price is down, we'll top up. And if the price is over the top, then we'll trim that position. So being actively managing those companies is really important too.
You raised it then, I think, alignment of interest, given your mentor, your background.
Yes.
You mentioned how you get paid. How do you get paid on the PE side and listed funds? Is it straight MER plus performance fee? And I guess the key thing there is, what is the benchmark or hurdle?
Yeah, no, it's a good question. So the way we get paid within the private equity sense is the same way that most reputable private equity firms globally get paid, which is, one, we put a lot of our own personal money in the fund. So we're rewarded as an investor alongside others. Two, we're paid a management fee, which is based on the committed capital, not the invested capital. So it's quite important. So we're not rewarded just to put money for work, not just to invest for the sake of it. Investors trust us with their capital over usually a 5-year period to invest that capital and up to another 5 years to exit those businesses. And that helps keep the lights on and help us attract hopefully the best and brightest in the team. But the way that we really get the best and brightest and the way that we get wealthy then is by investing our own money and then sharing in the profit. So once we've returned all of the money back to investors in a cash sense, so not an accounting valuation theoretical sense, but once we return all that cash back to investors plus an 8% return, then essentially there's a catch up and 80% of the profit goes back to the investors and 20% goes to the investment team. So it's a pretty standard. Yeah, that's right. I mean, there are some firms which do it more deal by deal. We've never philosophically done that because we think it's not fair that you could lose capital on one deal and then you make money on another one, you charge your investors on the one that does well but not the one that does badly. On the listed equity space, it's a traditional funds management fee model, again, where we're paid based on it's a lower management fee, but based on the net asset value of the fund, which is basically the value of the shares and less the expenses. And then again, we put a lot of our own personal money in the funds, and then we get a performance fee such that if in the last 12 months the fund has achieved more than 10% per annum, I mentioned that was kind of our sort of target. An absolute, it's not relative to the market, absolute 10.
Over all the years I've had people say, oh, no, we're an absolute return fund.
Yes.
But our benchmark is the ASX 200.
Yes. We have no benchmark for how we're paid at all.
Follow the money.
Yes.
The behaviour. Show me the incentive and I'll show you the behaviour.
Yeah. Yes. So that's right.
That's helpful. Now, just to close out, it's been wonderful for you to share your time. You mentioned Appen then.
Yes.
I reckon it's how we first met via Appen. A very good mate of mine.
Yes.
Carl Felsenberg, who's been a mentor of mine over the
Yes.
last 30 years. I worked for him and alongside him, at Newport Capital in the early days, sort of breaking out spreadsheets for him and the team. Talk to us a little bit about the journey of Appen.
Yes. Yeah, look, Appen's a phenomenal business. I should caveat by saying I've had no involvement in the last 5 years. So this is a note in history, if you like. So Appen was founded by a husband and wife team. Julie is a brilliant linguist. She was, not your stereotype of a technology. Today, Appen would be called an AI business. So it's essentially its clients are the large technology companies, and it's involved with providing sort of language services and tech-enabled services, if you like. And so Julie was an academic. She's a grandmother. She's not your stereotype of a sort of startup sort of entrepreneur. Her husband, Chris, worked at Telstra, senior executive there. And as the business took off in their home on Sydney's North Shore, then he retired from Telstra, came and joined her. you roll the clock forward. They had two super smart kids, but who had no aspiration, though, to work in the business longer term. So when we approached Chris and Julie and said, look, we've noticed you've got this amazing business. Looks really interesting. Would you be interested in having a chat? They said, look, we would be interested. Julie said, look, my husband's now almost 70. I'm not far behind. We love the business, but we'd like it to, continue well beyond us as well. So cutting a long story short, we then spent several months doing detailed due diligence. We acquired a majority stake. The family held on to an ownership within the business. Chris and Julie stayed on the board. And for them, because they were starting to step back, they wanted us to help them hire a CEO and a management team. We helped them hire initially a guy called Bill Pulver, who did an awesome job running the business. And the team, the senior executives, wrote a check alongside us as well. And I think it was now about 5 years later, we listed the company on the Australian Stock Exchange. I thought Anacacia would, we sold some of our shares. We were going to keep some in escrow to sort of show that alignment of interest for the future sort of investors there as well. And I was going to step off the board. I wanted to be on the board of private companies, listed companies. We typically don't like to be on the board of the listed companies. And Chris said to me, what do you mean you're going to step off the board? And I said, well, it makes sense. I said, but I'd love you to stay on as chairman. He said, oh, look, I'm not sure I'm the right age and stage. Maybe investors wouldn't want me there. Maybe you don't want me there. You're going to still be a significant investor. We said, Chris, we absolutely want you to stay as a director. Julie said she wanted to come out of the sort of limelight. And so Chris and said, I'll only stay on the board if you stay on the board for at least a year. So I stayed on the board for a bit over a year, and Anacacia stayed on the share register for about 2 years. And it was phenomenal business, and they did extraordinary things. I think we invested at, I don't know, maybe 8 cents a share or something. And I think the last share we sold was almost $40 a share. And it was a great ride along the way. And the family, we didn't sell everything at the end. We sold some along the way, and a lot of people joined that journey. And, once you're listed, of course, when you join and when you exit can make sort of a difference. But at the end of the day, the founders who we'd sort of back sort of retired and moved away from the business, and there were some management sort of changes, and it didn't quite fit the criteria that I mentioned before about, management, the business, and kind of a fair sort of price. So we haven't been an investor for the last 4 or 5 years, but it's great to see an Aussie business that's done, phenomenally well, and it's got its challenges and opportunities now in the world of AI, and so yeah, look, it's great to see companies that transition through private ownership and then can have a life of their own as a listed company, or businesses like Rafferty's we were speaking about before. My kids still get annoyed. My oldest is 21. He still says, Dad, why do you still look in the baby food aisle? You haven't been on the board of that business for sort of years, but we're still passionate about these companies that we sort of back, and sometimes they become listed, sometimes they stay private, and you learn from mistakes along the way, and you also learn from the successes, and hopefully that makes us and our team better investors going forward.
Jeremy, thank you very much for joining us at Inside the Rope. Congratulations on Anacacia, the career today. Really looking forward to watch what comes in the future. Thanks for joining us at Inside the Rope.
Thanks so much, David, and congratulations to you. It's always a pleasure listening to the Inside Rope podcast, and it's incredible what you've achieved at Coda as well. So thanks so much. Great to have a chat.
Welcome back, listeners. I hope you enjoyed our conversation with Jeremy. Tom, what'd you get out of that?
Yeah, lots. I think going into the episode and before you recorded it, it was a bit about how Anacacia chased value and not scale. So a lot of the big private equity shops globally now are chasing scale. They want A, more capital and more investments, and B, they want investments where there's going to be a high growth trajectory. What Jeremy talked about with Anacacia is they're more value driven. They just want boring, highly profitable family-run businesses. They keep the family members operating the businesses, and they sit alongside them. And using MGI as an example, he was really able to articulate and paint that picture. So I thought it was a great episode. What stood out to you?
Yeah, I think the fact that there's been that lack of scale and the alignment of interest, I think that's creating in that, a meaningful amount of the people making the investment decisions, a meaningful amount of their financial remuneration is actually coming from the performance of the underlying investments rather than the value of the fund manager getting much bigger as they distribute more and more product and become much larger. I get the impression that they've had the opportunity to do that, but they've chosen a path less trodden and stayed, true to that knitting, if you'd like. And that might have hurt them in some sense, and it may be a benefit in others. So, I think that alignment of interest stood out to me, which I really like. I think, that dovetails well to the small cap space. The thing that rings in my head over and over, I think we covered in one of the previous podcasts, that in the private equity world, the investment target has to choose you as well. So it's not really just a numbers game, and I think you can add considerable value if you've got expertise and you can attract the right investee companies. And I love just the meat and potatoes style of companies that they're investing into. It doesn't do my head in. It's not sort of saying you're going to have data centers in Mars and 1 million people living in Mars for this business to work, which I just can't fathom. It's sort of, we're going to make MGI, or we're going to make food, or we're doing things that I can really get my head around and believe with a high degree of confidence that the future cash flows are going to exist.
Yeah, I think.
So, yeah, I like that.
Yeah, I think, like as you said, it's almost this element of courting between the PE businesses and the businesses that they invest in now. And Jeremy spoke about the exclusivity of what they do. They don't go through a competitive tender process for these companies. They're out there looking, actively trying to find them, to invest in them and work with them. There's a few other firms doing a similar thing right now. And I guess the only question in my mind with that, and I really like that, but the only question I always have is, how do they know they've gotten a fair market price? Without that going to a competitive process, what is the fair valuation that sits behind it? But I agree, it's an interesting place to play.
Yeah, I get the impression that they're not paying too much for anything at most cases. So you probably rest on that. It does sort of raise the question where I think you're seeing some other scale providers come in with a real, almost industrial machine of producing that.
Lead generators and the like.
Just wonder if, to be in front of that. But then, maybe they utilize AI and other tools to automate that process. So, I thought it was a good conversation. I just think having good people who are really talented and smart and hardworking, the more people you can talk to in that area and learn from, the better.
Absolutely. Good episode.
Thanks, Tom. Hope you enjoyed it. And please remember to keep your feedback coming through. You can email me at david.clark@codacapital.com. Thanks for listening.
Thank you for listening to Inside the Rope with David Clark. Be sure to subscribe to this podcast on iTunes. You can connect with David by visiting codacapital.com. Any views expressed in this recording represent the personal opinions of the speaker and do not represent the view of any other party. If this recording contains reference to any financial products, that reference does not constitute advice or recommendation and may not be relied upon. Listeners in Australia are encouraged to visit www.moneysmart.gov.au to obtain information regarding financial advice and investments.